Welcome to the NGEN Markets Training session. Meanwhile, others are joining in. We will start with our session for today. So today's topic is screening for mutual funds, building model portfolios. And then we will actually talk about a couple of various topics, subtopics, which is, various filter parameters, rolling return analysis, positional overlap for diversification, and building and optimizing portfolio using the improve function. So these are the four main topics which will help us to build model portfolios by screening the mutual funds. And then we will head over to the Q&A section. So we will open the forum for Q&A. If you have any questions or query, you can either write it on the chat box or verbally after the session, and we will try to address them. So here, let's take my terminal to the NGEN Markets. Just a second. So as you can see, this is the NGEN Markets terminal we have right now. And to start with our session for today, what we are going to discuss here is specifically the fund screener. Now, this screener is very robust. So I'm just going to give you some tools and ideas that how you can effectively screen the funds for model portfolios. So for an example, let's take a brief example of filtering some categories here. So I'm just gonna add in some of the categories in equity, and we are going to make a portfolio on a conservative equity side. Right now, you can make different sets of portfolios with different sets of parameters, but one single set of portfolio will help you understand how the process works, and you can make your own process accordingly into the system. Right. So here, when you filter the categories, all you need to do is head over to the main selection, filter a category here, and we are selecting all the equities here. Now, to select all the equities here is that you can remove some couple of the couple of the categories you want. So for an example, I'm removing some of the categories here in the system, right? So as you can see here, that these kind of categories are removed now, and you will now see couple of funds which are added into the system based on the filter category I have chosen. And here, what you can do is you can also filter other parameters. Now, before going filtering and before going ahead with the filtration of other parameters, what you can do is you can actually toggle in the show top. Now, this is useful if you want to toggle more funds in your system. So for an example, if you see just 50, then you will see only 50 funds in this particular set of a list. Now, if I want to see all the 300 or more than 200 funds, all I need to do is just click on this 300 and apply. Now here what it will do is it will apply all those funds which will fit my criteria of 11 categories in the system, and then I can apply the filters accordingly. So here let's go ahead with our second process, which is applying the filter. Now to apply the filter, you can choose your own filtration process. I'm just giving an example here. So for an example, let's choose a process of minimum AUM as 2,000 crores, right? So if I choose this and apply this, you will see only those funds which is having AUM more than 2,000 crores. Now let's choose other filtration like the age, the Sharpe's ratio, and the value at risk parameter. So for an example, if you want to choose an age, let's say 5 years. So these will show only those funds which are having age more than 5 years. So now we have taken another filtration of 5 years. You can choose accordingly like 7 years and 10 years as well, but we have chosen 5 years here. Now here we have two more parameters, which is based on risk and risk adjusted return. Now let's talk about risk adjusted return, which is Sharpe's ratio. Sharpe's ratio helps us to determine that based on the standard deviation, what has been the return generated. So for an example, if I have a very good Sharpe ratio, for an example, let's take a look towards the Sharpe ratios of these all funds, right? You can sort in the Sharpe ratios and see here that Axis Small Cap, Nippon, Franklin India, these funds are actually having a very high Sharpe ratio in an equity domain. Now, what you can do is you can choose to have a Sharpe ratio in the middle of it. So for an example, I'm choosing a Sharpe ratio of 0.40. Now within equities, you can choose as per any required Sharpe's ratio, and then you can apply. And once you apply it, you will see these are the criterias you have chosen, and these are the funds which fits your criteria. Now this is another way to actually reduce the entire structure of all the mutual funds and come up with a smaller structure so that you can analyze them later on for your own processes and model portfolios. The next process is definitely to take a look towards the value at risk. Now, where is value at risk? It's given here minimum 95% historical VAR. Now, let's take a look towards the historical VAR in our list as well. To take a look towards historical VAR, the best way is to preset the columns. So to preset the columns, I'm just going to choose the risk columns here. So whenever you want to choose a column, we have different sets of columns, like all columns: basic, risk, return, equity, and debt. Now we are talking about risk here, so we are going to take risk column here. And you can see only these columns are there. And here we have value at risk. Now what value at risk signifies? It signifies that there is a 5% chance in a 95% confidence interval that these particular set of a fund can have a drawdown of negative 32, negative 32.15, or negative 31 as well. So these kind of parameters which will help us to understand the downside risk of it. Now, in this case, we are trying to build a conservative model portfolio. We would definitely not want to have funds which are very risky. So, for an example, with a high value at risk, will also bring in the risk on a downside basis. So, you can see these are the funds in equities which are having pretty high value at risk. Now, you can choose to have a value at risk parameter and filter it out, and you can then have a smaller set of funds in the list itself. So, for an example, let's take a value at risk as negative 28. Now, what does negative 28 signifies? It signifies that there's a 5% chance, 100 minus 95, within confidence interval of 95, that we could have a loss of negative 28 and not more than that. So we are choosing the minimum loss we would like to have is negative 28, not more than that. Once you apply it, you will see only these funds fits your criteria. And it's a smaller research area where you can see only couple of funds. It might be 25 30 funds which will fit your criteria accordingly into the system. Now what is the benefit of having all these filters and filter categories? How do you customize it according to your own approach? Now this is not a rigid process, it's very customizable. Let's say I want to decide on categories itself, which is large cap, flexi cap, and small cap, right? Only three categories. And once I choose these three categories, you can now see that based on my filters, only these categories are actually fitting the criteria. Now it helps us to determine that, okay, if I'm choosing funds only on one category, will it be backtesting into the system or not? And it helps us to determine that. So that's why I've chosen bigger range of categories here, so that you can take a look towards different set of diversified categories here, and then come up with your own recommendation as a model portfolio. So let's go back to our own model portfolio. So I'm just going to remove all the sectorals here. And once I remove it, you can, opt to cancel it. And then you can see that 11 categories contributes to a couple of funds which are more than 2025. So that's how it works out. Similarly, if you want to make it more conservative, not just on an equity side, you can either add some hybrid funds as well. So for an example, if I add in a hybrid fund here, let's say dynamic asset allocation or even equity savings, if I click on it, you can now see those funds are now backtesting into the system. For an example, Nippon India Balance Advantage. So that's how it works out. And that's how you can add in more categories and make a diversified approach accordingly into the system. Now, what about our second process? How do we, now we have screened the entire funds. We had more than 300 funds and we made them like 2025. How do we now make a model portfolio out of all these? We can't make portfolios of like 25, 30 funds. So what we can do is we can add these funds to the compare section. Now, there are two ways to add the funds. One way is definitely to take a look towards just by adding top 50 to compare. So now this is a best way, because what you can do is you can click on it, it gets added into the system. Other way is a manual approach. So you once you click on, let's say, add to compare, three of the funds will be added into the compare section, as you can see here. But let's say if you click on this add top 50 to compare, it will add the top 50 or less than 50 funds. So let's say if I click on it, you will see that we have 27 holdings, which are 27 funds, which are now added into the compare section, right? Now, this is our area where we will be working upon, and we can save this list accordingly into the system. So for an example, let's, take a look. Yeah, so I just got a message. Am I audible?
Yes, your voice is clearly audible.
Sure. Okay. So, yeah, sorry for interrupting. I just got a message in the chat box, so please check your system. Let's continue ahead with the process here. So here what you can see is our main list, which you can then save it accordingly into the system. Now let's review our categories and let's see how we can then, make our system lesser, because now this is still a big amount of number of mutual funds which we can't make a portfolio of. So for an example, if you see the categories, we have couple of categories in mid caps, small caps, value, flexi and ELSS. So, to just take a look into it, we have given this system where you can actually sort in based on any particular criteria, even the names, categories, and even the prices if you want. So it gets us an idea that, okay, these are the categories we currently have in the system and how do we diversify it? So first, before diversification, we would definitely want to have funds which are fairly conservative. Now, to get a fair conservativeness, we can run rolling analysis. To run rolling analysis, you can head over to the rolling analysis tab. Now, rolling analysis is a pretty huge tab. It can become another session anyway, but I'm just gonna give you just that how you can use rolling analysis, and then how you can build up those funds based on the rolling analysis. So, first example is to take a look towards a short-term approach. Now, why short-term approach? Because in equities, I would definitely want to understand that on a short term basis, like a 260-day window, what is the risk I would actually endure from all these funds? So, for an example, let's take a statistic here. We have a rolling window of 260, which is considered as 1 year, working period in a year. We have a start date, which is a minimum common period considered for all the funds. A youngest fund start date will be taken here, and the end date, which is a current date. And what you can do is you can also have a statistic to be changed. So we have two types of statistic here. We are having a simple written statistic and a point-to-point return statistics. I will talk about these comparisons between these two statistics, but currently for this seminar, we are going to be using, the simple return stats, which will be pretty helpful. So for an example, let's take a simple return approach. We have a methodology as annualized, and now we are gonna review the funds based on the simple returns. Now, what is rolling analysis? And how do we come up with a accurate, assumption that these funds are lesser riskier and these funds are, highly risky based on this list? So what you can do is rolling analysis is basically the rolling window. You can roll in all the 1 year data sets daily into the system. It is kind of like investing for a 1 year period every day from a start date to end date. Now, once you do that, any data point you choose. So, for an example, a data point here for Parag Parekh, which you see is 13th November 2020. It shows right now 24.86%. Now, this 24.86% is the sum of the previous 260 days daily returns. It is a 1 year return, simple returns. So, what you do is when you go back, you can see it is rolling in a such a way so that you can get all the data sets. Sometimes you might have very high returns, sometimes you might have very low returns, right? So that's how you can get an average of all these rolling data points, which are rolling periods. And this is what the average signifies. A good average is definitely, a higher average. So this is the average of 1 year every single day from 2015 to 2023. Now this is an average rolling return. Now we have other parameters. So another parameter is a volatility of this rolling return. Now what this volatility signifies is the standard deviation. How volatile are these rolling periods? So as you can see, how the more volatile it is, the more frequency it is that it can go as high as possible and as low as possible. So for an example, if you see Nippon India, it is having a very high volatility as a rolling volatility. And it definitely shows that it has gone as high as 88.02, but even it has gone as low as negative 42.84. Now, what this high and low signifies? It signifies that there was one period between these two start and end date, which has backtested 88.02%. Now, this is when you would have been making the best decision at the best point of the time, and you would have, backtested 88.02%. Now, another one is actually the worst case scenario, which is negative 42.84%, which shows for Nippon India. Now, this is the lowest return generated for Nippon India for a simple return basis for a 260-day rolling window. And this is the range. The range is basically the absolute difference between the highest return generation between any fund and the lowest return generated. So you can see here that the higher the range, the more volatile the funds are. You can see some of the range are pretty high. For an example, quant small cap is one of the highest volatile fund in the entire list, and then the positive percentage. Now this is pretty interesting because any data point which we were talking about were rolling periods. So let's say we talk about this data point. It's a rolling period of 2021. previously backtested for simple returns, 106, return sets generated from the sum of the previous 260 days. Now, what you can do is you can understand that this is the frequency of the rolling periods in positive. So I would definitely want to have frequency higher, not lower. So for an example, if we just talk about quant small cap, from this particular start date to end date, there was 76% of the time this fund was positive for a 1 year period. But 14% of the time, but you can see that 24% of the time it has been negative. So you can definitely see that how the positive percentage helps us to determine the frequency and the probabilistic approach for any particular set of a fund. Now here, what I'm choosing here is the funds with better positive percentage. So you can toggle around with positive percentage, higher or lower, and accordingly choose the funds into the system. Now here in this case, as we are generating a conservative model portfolio, I would want to have my funds which are having a very high positive percentage. So these are the funds which I have, and I would definitely choose like top 15 or top 20 from all of it, because any which ways we have lots of funds and we cannot choose all the funds in our portfolio. So for an example, I've already saved an Excel for this purpose, and this Excel will show you that these are the top 15 funds which we have currently chosen based on the positive percentage. So I'm just going to highlight this positive percentage. I hope this Excel is visible to all of you, and these positive percentage signifies that these are the funds which are chosen. Now what you can do is you can take this list of the fund and then save it in our main list. Now main list, you can either remove it from here, or what you can do is you can start adding from the main list itself. So we have the main list. What we can do is we can add from our pre-saved main list here given in the system. So I have a list of this conservative fund which is 15 items, and you can now see all these funds which I've chosen are actually having the best positive percentage from my previous list. Now this list is gonna get more smaller because 15 funds are still a lot, right? So how do we make it more smaller? We can actually take an approach of diversification here. To take an approach for diversification, what you need to do is follow a next process, which is go to the uh, position overlap here. So to go to the position overlap, what you can do is when you go to the position overlap, you will see a couple of funds here added into the system, and you will see some position overlap between the two funds. So for an example, let's say we are taking a look towards a very high position overlap. Now this is a matrix which will help us to see the diversification. So here what you can see is Mirai Asset Tax Saver Fund versus Mirai Asset Emerging Blue Chip Fund, which is having a 74% position overlap. Now, I would not like to have funds which are having, pretty high position overlap. Now, this is not where we can achieve diversification as such. So what you can do is you can start removing funds which are not, fitting the criteria. So for an example, let's take an approach here. Now, in the position overlap, you can either follow a horizontal approach or a vertical approach. Now, what is a horizontal or a vertical approach? As you can see here, that in the top you can see Mirai Asset Tax Saver, and in the left side you can see that list of the funds, and you can see the oranges here, which will when scroll down, you can see the most of the oranges are given here. So in this sense, when you follow the vertical approach, you will understand that tax saver is actually having high position overlap with iProve value discovery, with Franklin Flexi, with Capital Builder Value, with Canara Robeco Tax Saver, and Tax Advantage Fund with Bandhan, and even Mirai Assets. So there's a high chance that if I remove a tax saver fund, these all position overlap will be gone. So I'm just giving an example here. When you go to the main list, you can just go back and remove a tax saver, which is Mirai Asset. And once you remove it, you can then see the position overlap here. Yeah, it's pretty much gone. You can see that 74%, most of them have been gone. You can also follow this approach again and again, and then come up with your own model portfolio. So for an example, let's follow another process. HDFC Capital Builder Value Fund. Now it also has three sets of position overlap into the system. So for an example, when we follow the horizontal approach, you can definitely see these kind of overlap going on with the Capital Builder Value Fund. Now this is basically the one. When you click on it, let's say for an example, IFL Focused Equity and the Capital Builder Value Fund, if I click on it, I can see the overlap between them. So these are the exposures, these are the stocks and the securities which are currently overlapping. Now, if I remove the capital builder value fund, there's a chance that these all, oranges will be gone. Now, this will help you to understand that how the position overlap works out and how you can start removing it. There is no hard and fast rule that which fund should be removed and which should not be. It depends upon your criteria. Another criteria can be that if I have capital builder value fund and if it is not fitting my criteria of Sharpe's ratio, you can go back to the main list. You can choose to just take a look towards Sharpe's ratio. So what you do here is you click on this all columns and remove all of them and just select Sharpe's ratio. I'm just going to follow the process again. This is show and hide columns, which will help you to just reduce your list for some certain parameters. And then what you can do is you can then follow along and see that is capital builder value fund is actually having a good Sharpe's ratio or not. So for an example, it does have a good Sharpe's ratio compared to others, then you can definitely take a look towards it and remove it or not remove it accordingly into the system. Now, these Sharpe's ratios are since inception of each fund. You would like to have Sharpe's ratio based on one particular start date. To do that, all you need to do is just click on the settings button and just click on the start date. Now, when you click on the start date, what you need to do is, let's say, last 5 years, right? And once you click on it, and when you click go, you will now see the Sharpe's ratio based on the last 5 years. And that is how it works out, because at Engine, we calculate all the data sets daily. And that is why you can actually customize your start date and then check what has been the Sharpe's ratio. Now, the Sharpe's ratio currently for capital builder value fund in a current scenario has not been pretty good. So you can definitely, take a look towards it and then, remove it into the system. So let's say we are just removing it right now. And then once you remove it, when you come back to the position overlap, you will now see a lesser diversification, a lesser kind of, position overlap, which will increase the diversification. Now let's take this as a model portfolio and then build it again. Now you can remove others as well. We have a couple of others which are going on into the system, but that is how the process works out in the position overlap itself. It's a great tool to diversify and then come up with a model portfolio. Before going ahead with a model portfolio, once you have done this, you can save the list, right? To save any list, all you need to do is just type in the name of the list. Now, let's say if this is my fixed amount of funds which I will be choosing for model portfolios. What I need to do is I'll just type in a model portfolio here, right? Equity model portfolio, right? So what it does is it saves the list accordingly into the system. And once I click on the save button, it will be now saved in my list. Now you can create as many lists as you want. And once it is saved, let's say if I load in some other funds, let's say these one. And if I want to again load in my own model portfolio because I want to take a review of that, what I need to do is just go to this my list, and then I can just check my equity model portfolio into the system. So that is how it works out, and that is how you can take a look towards it accordingly. And once you save it, let's say you can see this. This is our equity model portfolio with 13 items which we have chosen. And once you add it into the system, it is now onboarded again. That's how list works out, and it's pretty useful if you want to use it for your own purposes. Now, if you want to make it your own model portfolio, how do you do that? One particular way is to convert to the portfolio. So if I click on this convert to portfolio, it will now be converted to the portfolio on an equal weighted basis. Now these portfolio will have equal allocations in the entire set of a portfolio approach, and then you can start analyzing it. So now this is our third process. How do we come up with accurate allocations for the portfolio, and how do we review such a portfolio? Is it conservative or not? Right? These are the questions we will have. So what you can do is you can go to the portfolio section, and once you go to the portfolio section, I'll just collapse this all. This is a great way to actually see the folders here. And in your NGEN Markets terminal, you will see your model portfolio from compare section. So this is the compare section which the folder which will be generated. And once you click on it, you will see from compare here. And once you run it, you will have the model portfolio which we have previously generated with 13 positions, and then you can start reviewing it. Now, before reviewing it, we definitely know that these allocations are not adequate and not ideal. We would like to improve our allocations. To improve them, we have an improve button here. Now, this is a portfolio allocation improver. So what it does is it's an optimizer. When you click on it, it will have 6 sets of models which will generate different sets of scenarios and give you an idea that compared to your equally weighted or any weighted portfolios, how do you, manage it accordingly to the based on the asset allocation. So for an example, when you see here the input data, which is currently 30th October 2014, which is a minimum common period of all the current funds added into the system. The youngest fund's start date is currently taken as a start date of the entire portfolio. Now, the second process here is that you can see the original allocation, which is equally weighted allocation, right? And now we have two sets of models. One is a ranking model, another is a value model. So we will talk about these two models in detail and how this model will actually help you. So for an example, let's talk about ranking model. Ranking model is a model which is highly concentrated towards one fund, which will contribute toward one parameter. A parameter can be return, a parameter can be a minimum volatility, or a parameter can be a Sharpe's ratio. So for an example, if you want to maximize Sharpe's ratio in your portfolio, then what you need to do is follow the rank Sharpe, because rank Sharpe will allocate highly towards that fund, which will be contributing highly towards the portfolio on a Sharpe's basis. You can see the highest Sharpe's being achieved by rank Sharpe, which is 0.62 on an entire portfolio approach. Similarly, if you're taking a look towards a conservative portfolio, which is our motto anyway for this particular session, is the minimum volatility rank. You can see here that our volatility is the most least minimum wall we can actually take a look towards. And here what you can see is that Parag Parikh flexi cap is highly allocated due to the fact that it is having a minimum volatility in this list. Now this is a list of equity mutual funds only. If you have some debt and hybrid funds, there is a possibility that those funds will be highly allocated in the minimum volatility rank system, right? So this rank system will help you to determine, do you want to maximize return? Do you want to maximize your, the volatility, minimum volatility, or do you want to maximize the Sharpe's ratio in the portfolio? So in this case, what we are going to take a look towards is the minimum volatility in our system. Now there is another set of a model, is value model. Now value model is a balanced approach. What we do in the value model is we do not give very high allocation or a concentration to one fund. So for an example, when we take a look towards return value, what you can see here is a very high allocation for SBI small cap. Whereas when you see in the right side, the allocation is 10.33, which is not, very high, which is not like 30, 35, 40%. It's just 10%, but it's still the highest allocation in the portfolio. And that is how value model can also be a good optimizer on the basis of balanced approach. Definitely, you would not like to, input all your 30, 35% in one fund. That's going to be a too much of a concentration. That's where value model comes in. It gives you a balanced out approach, and then you can take a look towards it based on three parameters, which is similarly return parameter, minimum volatility parameter, and Sharpe's value parameter. So any parameter would work out for you, but in this case, I'm just going to take a look towards minimum volatility rank. Now there is another, another model which is equally weighted. Now this model will be more useful when you have, previously different sets of allocation, and you want to compare your original allocation with equally weighted to set a benchmark. Now in this case, both are the similar, same equal weighted model we currently have. So what we are going to do here is we are going to save one of the model, and then we are going to analyze the entire set of a portfolio. So let's save a minimum volatility model, because this is our entire motto of a session, that we are trying to make equity conservative portfolio. So what you do is you save it. I'm just going to type in equity conservative as of now. And this is how you can create. And once you create it, it will be saved in the portfolio improve section. The portfolio improve section is a section where we have created a folder itself. So when you look into your NGEN Markets terminal, all you need to do is just click on this collapse all, and you will have from improve button, which is a folder. Now this is a repository. It is a very useful way to manage portfolios here. I'll show you how you can manage portfolios in the next coming couple of minutes. But when you click on improve, you will see the equity conservative, which we previously generated. Now this is a portfolio which we have generated with 13 items. And we will also take a look towards correlations shortly in the next couple of minutes. But before going to correlations, we will take a look towards the performance of the portfolio. Now, this is how the performance looks like for this model portfolio, which is a conservative portfolio. And it definitely is when you're comparing a TRI, let's say Nifty TRI here. right? So you can change the benchmark from here. And when you're comparing and checking up that did we actually create a model portfolio or not, which is conservative, you can directly compare with the TRI and check that the value at risk which we currently have for a 5% confidence interval, is it lesser than the benchmark? Is it better? For an example, you can see that our risk is actually lesser, whereas the benchmark's risk is negative 25. And it denotes that in the 5% confidence, in the 95% confidence interval, there's a 5% chance to have negative 16 for our portfolio, whereas negative 25 for benchmark. Now, this is a great way to understand that we are lesser riskier. And hence, we are also generating a very good set of an annual return, which is 14.26 against a benchmark from the last couple of years. Now, here you can change the scenario. If you want to change the scenario, you can change the confidence interval itself. All you need to do is from 95, you choose 99 or 98. So 99 would be that there's a 1% probability, 100 minus 99, that you could have such a drawdown. So it's negative 32.69. Now, this is a probabilistic approach again. It's based on the historical daily returns data sets. And this will become another session anyway, but this will help you to understand that did we create a conservative portfolio in equity against a benchmark or not? And the question can be answered here. So these kind of analysis you can do in the performance stat, but the main point is to check correlation as well, because even if we achieve a good position overlap, correlations can be definitely be high because all our equities in the system, there are no debt or hybrid funds. So when you click on correlations, you can see here that there is a high correlation somewhere going on. So for an example, a high correlation between Bandhan tax advantage versus HSBC value fund, which is 0.93. A high correlation is closer towards 1, whereas a low correlation would be farther away from 1 or closer towards 0. A lower correlation can be like Parag Parikh versus all the funds. Now these kind of correlations can be skewed because Parag Parikh does have some foreign equities here, but what you can take a look towards is definitely like SBI small cap versus IFL focused equity. You can see that if it is making sense or not. Now correlation is also daily calculated in the engine market system, and due to that, what you can do is you can choose to see what is the correlation between these two scenarios. So, for example, I can choose a date here, 2018, and I can choose an end date here, let's say 2022, right? And once I run it, now I can see that in this last 4 years, 5 years, in between 2018 to 2022, most of the equity funds were highly correlated, and that's the truth. You can see here in the system. That is why taking a look towards high correlation is definitely important, because in this in this scenarios you can see how it works out. For an example, I'm just giving an example here. Let's say equity conservative, if we just add in one hybrid fund. Now it is just a use case scenario which we are taking a look towards. So let's say we are adding a arbitrage fund. Now this will definitely give a correlation which is different than all the equities, and it's gonna be the case. But that is the point anyway, to see that if we are highly correlated or not, or lowly correlated or not. When you check here, you can see some negative correlations going on versus some equity funds. And that is the reason, if you would like to choose a arbitrage for your portfolio, then this would be a reason, because most of the equities are performing similarly into the system, and you can now have a diversified approach with an arbitrage fund. So that's how this works out, and that's how you can actually create different sets of model portfolios into the system. Now, this is one set of a model portfolio. How do I create multiple? You can create multiple with the similar processes we have given you. It is not a rigid process. You can have your own processes accordingly and make a proper system. And once you are done with the process, the best way is to actually manage those portfolios in a system, which are folders. Now, these folders are very useful because let's say I want to add my portfolio of this which I have created in a live sense in my February strategy. So what I need to do is all I need to do is just go to the improve section, which is this folder which I have. And I need to click on this, and I can move this to a different set of a folder. So from improve, this is my folder, but I can move it to my February 23 strategies. Now I can start managing my strategies. And you can see here that I currently have couple of strategies in debt, hybrid, adventurous, most of the strategies are given here. So this is the process I followed from my side, but you can follow your own processes and come up with your own recommendation. So for an example, I'm just going to show you an equity strategy, which is a highly adventurous one. And you can, this is a highly adventurous strategy, which includes, highly risky funds. in the equities into the system with the performances. So that's how it works out. That's how you can actually take a look towards model portfolios. And one important thing is that, after creating model portfolios, it is important to map it with your client portfolio, because that is where we want to know that are we actually matching with the client's risk profile or not, because that is our end point anyway. So all you need to do is just go to the compare to portfolio section. If you have a client like, one of the client from RTA or a section, you can add it into the, we have an automation for adding client portfolio through the client section. And we also have some CAS uploads here with the statement analyzer. But what you can do is you can add in your own equity, portfolio conservative, and then you can start, analyzing them. So this is our equity conservative, which we have created currently in this scenario. And you can see from one particular start date, let's say we are choosing 2018, which is our 5 years. And when we compare it between the two portfolios, one in the left side, which is our client portfolio, other on the right side, you can definitely see the volatility is similar, whereas our annual return is actually higher. So that's how you can take a look towards, and that's how you can compare different sets of, model portfolios with a client portfolio and come up with your own recommendation. And if you want to create a PDF out of it, the best way is to click on it, create a password based PDF or a capital based. Let's say you want to deploy 1 crore of your clients, corpus into your equity conservative portfolio. All you need to do is make an action plan for this and click on it. Once you click on it, the PDF report gets generated into the system, and I'll just showcase this PDF report for the session, and you can see this is how it looks like. So this is a co-branded PDF report, and you can see all the comparisons of asset allocation and all, which is another session for the comparisons of the portfolio. But you can see the action plan here, because this is the main point anyway, that if the client agrees to go ahead with your model portfolio, what kind of what kind of allocations would you be giving on the basis of lakhs and crores and even thousands. So this composition will help you to make an action plan, that if you want to reduce all the positions and you can have this kind of an allocation, then 31 lakhs should be given to Parag Parekh and 15 lakhs should be given to Axis Small Cap. So that is how it should be invested accordingly with your own action plan. So that's how it works out for the comparisons of the model portfolio with any particular set of a client portfolio. So that's it for today's session. And we can open our forum for Q&A. So if you have any questions, any queries regarding the, this session or any other tools, you can always write it in the chat box or verbally, and we will try to answer them.
Hello. Hello. Hello.
Yes, ma'am.
Yeah, please go ahead.
ये जो हम आप बोल रहे हैं ना कि मॉडल पोर्टफोलियो, ये लमसम के लिए बोल रहे हैं ना, तो जब हम लोग SIP के लिए पोर्टफोलियोज डिजाइन करते हैं, तो वही स्ट्रेटेजी अप्लाई करना चाहिए या कैसा?
मैम, अगर आप मॉडल पोर्टफोलियो में SIP का अमाउंट डाल रहे हैं तो वो ठीक है, लेकिन आपको मॉडल पोर्टफोलियो को पहली बात रीबैलेंस करना पड़ेगा एवरी फ्यू मंथ्स, क्योंकि ऑब्वियसली ये तो लमसम पे भी अप्लाई करेगा, बिकॉज अगर आपने सोचिए 2 फंड में 50-50% डाला है तो उस फंड की वैल्यू भी चेंज होगी, एग्जैक्टली सेम टाइप से चेंज नहीं होगी। तो आफ्टर 2-3 मंथ्स आपको चेक करना पड़ेगा कि पोर्टफोलियो को तो रीबैलेंस करना है कि नहीं। रीबैलेंस मीनिंग कि अगर आपने 50-50 मेंटेन करना, तो 3 महीने बाद वो 50-50 जो है वो चेंज हो जाएगा, एंड इसकी वजह से आपको थोड़ा सा बेचना, थोड़ा सा खरीदना पड़ेगा। इन द सेम वे अगर आप SIP कर रहे हैं तो एवरी मंथ जो आपका नया अमाउंट आ रहा है SIP से, आपको वो पोर्टफोलियो की जो होल्डिंग परसेंटेज है उसके बेसिस पे ऐड करना पड़ेगा। तो इसमें आपके ट्रांजैक्शंस बढ़ेंगे, लेकिन आप SIP में भी यूज कर सकते हैं।
ओके।
Hello.
हाँ जी, yes, please.
Yes, sir, a very small question. Let's say
Yeah.
client का portfolio है जहाँ पे there are let's say 10 schemes. Out of
Yeah.
those 10 schemes, let's say 3 schemes ऐसी है जिनका जो last year ही NFO आया उनका, and they are new schemes in his portfolio, his or her.
Yeah. Yes.
And उसके साथ जो मैं मेरे मॉडल पोर्टफोलियो से कंपेयर कर रहा हूँ, so let's say there are only 5 schemes and सबका 10 या 15 साल का ट्रैक रिकॉर्ड है।
हाँ जी।
नाउ ये केस में जब मैं कंपैरिजन करता हूँ परफॉर्मेंस का,
हाँ जी,
सो बिकॉज क्लाइंट के पोर्टफोलियो में 3 स्कीम्स ऐसी है जिनका पिछले 10 साल में से 2 ही साल का परफॉर्मेंस है। सो
हाँ
ये
जी।
लाइक टू लाइक कंपैरिजन हो रहा है क्या फिर इसमें?
देखिए, इसमें ये इश्यू तो है ही है। अगर आपके जैसे आपने एग्जांपल दिया, एक या दो फंड अगर नए फंड्स हैं, एक दो साल का डेटा है, तो होता क्या है कि अगर सोचिए आप, जैसे आपका 10 फंड का पोर्टफोलियो, उसमें एक फंड है वो सिर्फ एक साल पुराना है एंड उस पे एलोकेशन 10% है। तो
हम्म
क्या होगा कि आपके बैक टेस्ट में जो 10% का एलोकेशन है पहले 9 साल तक, अगर 10 साल का बैक टेस्ट है, तो पहले 9 साल तक जो 10% एलोकेशन है वो कोई रिटर्न नहीं देगा,
हम्म
लास्ट एक साल में ही रिटर्न देगा। अब इसके लिए हमने आपको दो ऑप्शन दिए हैं, उमेश, जस्ट रन अ सिंगल पोर्टफोलियो वंस। तो यहाँ पे आप क्या कर सकते हैं कि पोर्टफोलियो रन करने के बाद ना आप ऊपर देखेंगे स्टार्ट एंड डेट्स हम दिखाते हैं
हम्म
पोर्टफोलियो के सारे आइटम्स। तो यहाँ पे जैसे आप देख रहे हैं, जैसे अगर आप एग्जांपल लेने, कुछ कुछ फंड है 2014 में शुरू हुआ है एक फंड होता
हम्म
है, IIFL फोकस इक्विटी। तो मैं इसको क्लोज करो एंड जस्ट गो टूवर्ड्स चेंजिंग द स्टार्ट डेट। तो यहाँ पे हमने मिनिमम कॉमन पीरियड बोला हुआ है, इसको क्लिक करके देखो क्या स्टार्ट डेट आता है। ये देखिए 2014 का स्टार्ट डेट आ गया। तो
हम्म
जब ये स्टार्ट डेट आता है, इसका मतलब ये ऑटोमेटिकली आपको पोर्टफोलियो ऐसे रन करके देगा कि जब जिस स्टार्ट डेट के बाद सारे के सारे फंड पक्का लाइव है,
हम्म
जिनका 100% डेटा है।
हम्म
लेकिन अगर आप लंबा बैकटेस्ट स्टार्ट करना चाहते हैं, तो उसमें अनफॉर्चुनेटली कोई सोल्यूशन है नहीं, क्योंकि अगर एक फंड है जो नया फंड है, उसका कोई डेटा हिस्ट्री नहीं है, तो उसके पहले 10 साल तक हम उसके पीछे कोई रिटर्न नहीं दिखाते। तो अगर आपको बैकटेस्ट ऐसे रन करना है कि सारे फंड्स लाइव हो, तो आप मिनिमम कॉमन पीरियड से रन कर सकते हो।
नहीं, बट बहुत बार हो क्या जाता है ना कि 1920 या 1921, सॉरी
हाँ
2020 या
जी,
21 के फंड्स होते हैं। कुछ
हाँ
फंड्स
जी,
होते हैं जो 2010 या 2011 के इंसेप्शन के हो। तो अगर
हाँ
मेरा
जी,
वो मिनिमम कॉमन पीरियड अगर 2 या 3 साल का ही है, तो फिर
हाँ
वो
जी,
कंपैरिजन में कुछ सेंस ही नहीं बनता है।
नहीं
एंड
बनेगा।
सेकेंडली अभी हो क्या रहा है कि जितना भी क्लाइंट्स का पोर्टफोलियो में कंपेयर कर रहा हूँ, हर पोर्टफोलियो में या हर कंपैरिजन में मेरा मॉडल पोर्टफोलियो अच्छा कर रहा है। बिकॉज़
हाँ
टिपिकली
जी,
सारे क्लाइंट्स के पोर्टफोलियो में 2-4 ऐसी स्कीम्स मिल ही जाती है, जो
हाँ जी।
रिसेंट एनएफओज़ होते हैं।
तो
अ,
देखिए सर, इसमें ना मतलब इसमें जो भी सोल्यूशन है वो थोड़ा सा सब ऑप्टिमल ही होगा। फॉर
हुँ,
एग्जांपल आप क्या कर सकते हैं कि जैसे फॉर एग्जांपल अगर हम ऐसा करते हैं कि आपके जो दो नए फंड हैं,
हुँ,
हाँ, अगर वो 2 साल पहले ही स्टार्ट हुए हैं, तो हम 10 साल के पैकेज में फर्स्ट 8 इयर्स में बाकी जो फंड्स हैं
हुँ,
उनके एलोकेशंस को बढ़ा दें,
हुँ,
राइट। उसके बाद 2 साल पहले जब ये दोनों फंड आ जाए तो उसको ठीक कर दे। बट इसमें बहुत मिसलीडिंग हो जाएगा सर, क्योंकि अगर आपने किसी फंड को 10% दिया हुआ है,
हुँ,
पुराने फंड को,
हुँ,
उसकी एलोकेशन बैकटेस्ट में 10 की जगह 12, 12.5, 13, 14 हो जाएगी, जस्ट टू
हुँ,
फिल अप द एम्प्टी स्पेस।
हुँ, हुँ,
तो
हुँ,
वो तो डेफिनेटली गलत होगा, तो इसलिए हम वो पर्पसली नहीं करते। तो
हुँ, हुँ,
अगर आपको द ओनली अदर सोल्यूशन इज कि जो नया फंड है उसको आप बैकटेस्ट में मत रखिए, क्योंकि दैट्स दी ओनली वे आपको फुल एलोकेशन मिलेगा। अदरवाइज जो हमारा सिस्टम अभी कर रहा है इज दैट जब उस फंड का डेटा नहीं है तो हम उस टाइम पे जीरो रिटर्न दिखा रहे हैं। इसका एक फाइनल सोल्यूशन और हो सकता है, लेकिन वो थोड़ा कॉम्प्लेक्स हो जाएगा। इज दैट अगर एक फंड से 2 साल पुराना है, तो उसके पहले 8 इयर्स में, 10 इयर्स के बैक टेस्ट पे हम प्रॉक्सी यूज कर सकते हैं। तो फॉर एग्जाम्पल अगर आपने सोचिए कोई एक नया स्मॉल कैप फंड यूज किया है
हुँ,
और जो 1 साल 2 साल पुराना है, तो उसके पहले जो 8 साल 8 इयर्स का एम्प्टी टाइम है, वहां पे आप कोई दूसरा स्मॉल कैप फंड लगाइए। बट अगेन सर, इसमें जितना हम इसको फिडल करेंगे उतना ही मिस रिप्रेजेंटेशन हो जाएगा।
हुँ, 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 हुँ,
तो ये अनफॉर्चुनेटली एक प्रॉब्लम है जिसका कोई स्ट्रेट फॉरवर्ड सोल्यूशन नहीं है।
हुँ, 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 हुँ। ओके, 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 थैंक यू सो मच।
थैंक यू, थैंक
Hello,
यू। यस,
this is Kaustubh from Pune. Am I audible?
Yes, sir, you're audible.
Yeah. So, just wanted to check with I don't know that when we are comparing the existing portfolios,
या
particularly for the schemes in which there has been SIP or STP for a limited period of time, and if we have to compare the performance of those schemes with their respective benchmarks, so is it possible to do here?
So whenever you compare the performance of various different schemes, so for example, in the compare section, um, what happens is we show you some relative columns here. And there you can see the performance of these schemes versus one benchmark, not different benchmarks. So the reason for that is quite straightforward. Is obviously if you have 5 different funds here, and the alpha that you're putting together line by line is against various different benchmarks or their respective benchmarks, then those alphas don't are not comparable anymore, because one alpha is fund A versus some benchmark and the other one is fund B versus some other benchmark. So the alpha cannot be compared, right? Because the benchmark cannot be different. Because otherwise, you could basically technically you could pick a benchmark for any fund and it will always outperform it. So whenever we do a comparison in one place of several funds, we always force our users to use one benchmark against that set of funds. For the simple reason that, obviously, relative comparison has to be against the same benchmark. If it's not against the same benchmark, then the comparison won't really mean anything.
What I meant was basically when we are comparing a specific, when we are reviewing a specific portfolio. So in that portfolio, there are several schemes. In some schemes, there could be lump sum investment. In others, there could be SIPs going on.
Yes.
So let's say if we have to see whether a particular scheme is performing or outperforming its benchmark or not, that for that particular let's say requirement, is there any way that we can have it for that portfolio?
Well, whether a scheme is outperforming its own benchmark, that is something we do not track. The reason for that is because the benchmarks are generally been decided by the AMC. So as you can see, I mean, that's a big conflict of interest right there, because obviously, I mean, as a fund manager, I would just pick whatever benchmark works best for me. So what we try to do is give our users the ability to decide yourself, maybe use a category average or use a particular benchmark. Let's say something that SEBI has mandated, rather than what the fund manager thinks his benchmark should be. Right. So we typically, when you load a fund, you will see what the fund manager has denoted as their benchmark. It's a text there. And by default, if that benchmark is available with us, it will load. In this case, it has loaded, I think it's the 250. But we are free to change it. We don't force our funds to always show with the fund manager denoted benchmark. So generally speaking, on NGEN markets, we don't put much importance on the benchmark that the fund manager has set.
So this
we try to give our users
large mid cap 250. This is the benchmark by the fund manager or the AMC, right?
Exactly.
Fine. Now, what I'm trying to understand here is, like, for example, let's say if I have to review a particular investment in a particular scheme for a particular period, then, and even if we do not have that AMC's benchmark, any other way which can be reviewed for such a particular situation wherein the investment is, or maybe it's a 17-18, for example, 2017-18, 2 years investment, then in the stock. So would it be would I be right if I say that the right way to review is basically, let's say, if the same amount would have been invested in a benchmark, any benchmark, then what would have been the scenario?
Yes. So this information will be available separately, probably not in the portfolio view. So for example, if you in the compare section, and let's say you're looking at a bunch of large cap funds, you can definitely very easily compare all those large cap funds versus one particular large cap index that you might decide, Nifty 50 or something like that.
Yeah, but then if I have to, I mean, if I'm looking at from the perspective of a portfolio review, then this solution would not be the right one.
Yeah, it probably won't, because then you obviously need a large cap benchmark for a large cap fund, a small cap benchmark for a small cap fund.
Correct.
Right. So, I mean, we could probably look at solving this issue, because we know that SEBI has given recommended benchmarks for each of its categories.
Yes.
If SEBI has decided, then that is obviously an independent benchmark which can be, relied upon. So we can look at a way of, tracking an alpha for each fund versus the benchmark of their respective category.
Exactly.
That is something we can look at. Yeah.
For the same particular period in which that investment has been done. I mean, as far as where there is a staggered investment for lump sum,
Yes.
it is very easy and obvious.
Yes.
But for the staggered investment, again, the same alpha would be. Alpha can be calculated only if the same period is considered. Investment.
Is considered. Yes. I mean, if we are able to map specific benchmarks to specific categories, then what you're asking for is, is possible. So we will look into if this is available for every single SEBI category. If it is, then so we'll look into that first, and if that's possible, then what you're asking for is should be.
But your perspective, you do have a look. But
Yes,
you can
definitely.
take the feedback, and definitely if you can incorporate it, I suppose that will be really a very good value addition.
Understand. Perfect. We will definitely check it out.
Thank you so much.
No problem.
Hello.
Hello. Yes.
Folder system. Can I repeat? Can you repeat?
Where, please go ahead.
Mane. How can we
Sure.
create
So,
new folder?
sure, ma'am. To create new folders, we have given several ways. One of the way is whenever you're adding a portfolio here, we have given an new folder button here. So let's say we are loading in couple of fund through iSense, right? Now this is your portfolio. Where is a new portfolio I'm just adding, right? Now once you have done with the new portfolio, all you need to do is click on this active button. Now this is the folder currently it will be onboarded if you create it. But if you want to create a new folder, we will have a new folder button here. And once you click on it, you can name the folder as let's say webinar, right? And once you click on it, now it is a webinar folder created. And once I click on the create button, it will be now saved in the webinar folder based on the particular set of the folder which I have taken into consideration. So you can see we have the last folder named webinar and the new portfolio which is onboarded. Now let's say I do not want my new portfolio in webinar. I want it to be in, let's say, from clients. So all I need to do is just click on this arrow button. And in the arrow button, we have another way. You can also make portfolios from this arrow button, basically. All you need to do is just click on this move to and click on it, and you can create new folder from here as well. So let's say we want to create a new folder from here itself. I want my new portfolio in a new folder, which is called as webinar 2, right? So I'll just type in webinar 2 and once I save it, I click on this collapse all, which will save my time to review all of them. And you can now see webinar 2 to be added. So you can now see my new portfolio in the webinar 2. So that's how you can create folders and manage the folders. And if you want to definitely, move this portfolio to another folder, which is not a new folder, all you need to just click on any folder, let's say December debt strategy. This new folder will now be there in my December debt strategy. So you can see this new folder here. So that's how you can manage the folder, and it's very useful if you want to have multiple folders. It's like a Windows system where you have many folders and many portfolios, whereas you can save some client portfolios, some of your own model portfolios, and even some portfolios which are for your prospective clients. So that's how you can manage your folders here in the system.
Okay. Thank you.
Any other questions? Please do let us know.
Yeah, bro, like this is Tarak. I wanted to know how to add the list and
Sorry,
yeah,
what kind of
like
list do you want to add?
there is a column called adding list in comparison, right? Save the list, which we have
Yes.
filtered.
Yes.
Yeah, I wanted to know how to save it. Like I couldn't get it.
Okay. So Umair, let's just go to the compare section, add 2-3 funds, and just save the list. Let's just go through it clearly.
Yeah. Okay.
A second. So here you can see the funds here. We have 5 funds. You can add as many funds as you want from add securities. And you can click as, name it as a list here. And once you name it as a list, you save this list into the system. Once it is saved, you can head over to the, saved column where, I have a lot of list here. So, you can follow along and see that I have saved list here. And once I click on it, I will see all those funds which I have saved in the list. So that's how you can save any list in the My List section.
Okay, bro. Like
And
one more
furthermore,
doubt I have.
yeah.
One more doubt is like I'm unable to get the portfolio details. Like you went to the compare portfolio, right?
Okay.
Yeah. Like I'm not getting the portfolio details here.
So any portfolio that you've saved, either in the portfolio section or the client section, they will
In
show up
portfolio,
here. Yeah, go ahead.
in portfolio session, I have created like compare 1, compare 2, and some name as TTT, but I am not getting it in compare session.
So when you came to compare portfolios and you started typing the name, it's not showing up in your dropdown?
No, it's not showing.
Okay. So we can just, if you could please leave your email address, we'll check out your account, but I don't think this should be a problem, but just make sure that you type something in the search box, for the first 2-3 letters or something, and they should show up.
Okay.
Yeah. If not, but just please drop your email address on here and we'll
Got
check
it.
out.
Got it. Thank you. Now I got it. Like when I type in, it is coming.
So you just it's like an autocomplete. So basically you start typing, it will start showing basically.
Yeah, then that is fine.
Yeah.
Okay. Yeah. Thank you.
No problem.
Hello.
Yes, sir.
Mr. Arnab.
Yes, sir. Please go ahead.
Yeah. I just wanted to, see in the fund section, you have only funds under various parameters.
Yes.
Right. Now, it would be prudent if we have along with that the list of funds. Say you take, for example, large cap, for example, to every category, you should have at the bottom or at the top the category averages as well as the benchmark parameters, so that those funds are straight away compared to the category averages and the benchmark averages on one single page, and even for any filtration.
Right. So you can do this in the compare section. So here you can actually add an entire category, for example. And once you just Umair just add any simple category. Yeah. So now you can see we are adding all the funds in this category. And now we can add the category average. So there it is. And you can also add an index. Just let some pharma healthcare or something. Yeah. So you can see now we have a pharma index, we have a pharma category average, and we also have all the funds in this category, pharma category.
Okay. This is what I was. But this you have to do it in the compare section, is it?
In the compare section, yeah. Because sir, in the screener, the screener is literally just like it's like a really big browser for everything, right? Raw data. You can go through, you can apply filters and all. But if you want to do specific research on, let's say, one particular category, then it is much better to do it in the compare section. And anyway, in the compare section, you can see how many tabs there are. You can do everything, rolling, drawdown, this, that, everything is there, right?
Okay.
It really helps to narrow down. Like if you want to, for example, in this case, pick the best pharma funds, this is the best place to do it.
Okay. Okay. So,
सर इसमें जो मंथली एसआईपी है वो थोड़ा बताओ ना.
हाँ जी मैम, यहाँ पे आप देखिए जैसे हमने सारे फार्मा फंड यहाँ पे एक लाइन में सारे आ गए हैं और हमने कैटेगरी एवरेज भी डाल दिया है, साथ में इंडेक्स भी डाल दिया. अब यहाँ पे आप ऊपर टाइप कर सकते हैं, जैसे एग्जांपल है ये 5,000 रुपीज का एसआईपी है, स्टार्ट डेट एंड डेट है. तो यहाँ पे आपको सीधा दिख जाता है कि किस एसआईपी में सबसे ज्यादा पैसे बनते हैं. आप इनमें से किसी भी अगर म्यूचुअल फंड में पैसा डालते हैं इस लिस्ट पे जो है, और साथ में इंडेक्स और कैटेगरी एवरेज का भी वो थियोरेटिकल है ऑब्वियसली, वो भी आ गया है. तो यहाँ पे आप देख सकते हैं कि कैटेगरी एवरेज से बेटर कौन सा है, उससे वर्स कौन सा है. तो यहाँ पे आपको दिख जाएगा कि कौन से एसआईपी में ज्यादा पैसे बनते हैं ओवर दिस टाइम पीरियड. और अगर किसी भी एसआईपी को आपको डिटेल में देखना है तो आप यहाँ पे वो पिगी बैंक का आइकॉन है, इसको क्लिक करेंगे तो वो सीधा आपको एसआईपी का सेपरेट पेज खोल देगा जहाँ पे आप सिंगल एक फंड का एसआईपी फर्दर एनालाइज कर सकते हैं.
ओके. Even the value at risk also happens in case of category averages and benchmark averages.
I'm pretty sure it's there. मैं just have a look in the fund.
मेरे ख्याल से possible नहीं हो. I don't know.
नहीं सर, अगर नहीं हम डाल देंगे. Statistical value है, so we should be able to do it. I don't think it shows up here, sir. We have risk versus return, we have rolling returns, drawdowns, everything is there. But yeah, someone from the team, please note this down. We should in the fund list. I believe Sortino is upcoming, so we should add VAR also there.
Yeah. क्योंकि funds जो है ना, funds if you compare it with category and benchmark, then the filtration is much better.
Yes, fair enough. यहाँ पे and that for if you're doing category by category, then this section is much better for that.
Yeah, okay. Because whichever is higher, suppose category average is higher for certain funds, in certain funds the benchmark is higher. So if the funds are better than those averages, those are only to be considered.
Absolutely, sir, and that is very easy to find out here. You can just sort by 5-year return or 3-year return, whatever your consideration is, and in one go you can basically delete everything that is below the index.
Yeah, so that makes the task simple.
Yes, sir, and once you delete everything that's below the index, let's say you're left with 5-6 funds in that category, you save that list and then your work is done, right? Next time you come and you have those funds, basically.
Yeah, so even the value at risk comes, that would be fine.
Absolutely, so we will put that in.
And if I remember, I don't know, I would have suggested once, if you could, have the P ratios, PB ratios, PS ratios, PC ratios, ROC ratios, ROE ratios of the fund.
So, sir, most of the fundamental
to name a few. See, basically all these parameters which you have enlisted, they tell you the quality of the funds, how to filter down to the quality most fund, the best quality fund. But when the problem or the time comes to buy, I will always look at the total expense ratio and the valuation.
Yes, so the TER is definitely here. In terms of valuation, we only have P and PB. So we don't have any other valuation ratios on the system as of now.
I don't know, whichever you feel prudent and right, you can go for. But what all I mentioned are mentioned in the Morningstar AWS.
Understand.
P, PB, price to cash ratio, price to sales ratio, return on equity, return on capital employed, return on ROA, return on assets, because like in the case of Adani, they may not be good in return on asset, but Reliance, they are extremely good on all the aspects, including return on assets.
Right, sir. So, I mean, if you're looking at individual stocks, that you will find.
No, I'm not going by stock. I'm only talking about mutual fund on the whole, in a nutshell.
Right. So you want to see the weighted average of all these statistics.
Yes.
ROE,
So once, so at least if you have, even the historical earnings are also given, like you have given CAGR since inception. You could add a column there of the historical earnings.
Understand.
Along with the P, PB or whatever. P, BB, yes. ROC, ROE, ROA, PS ratio, PC ratio.
Understand. Okay,
I think these data are available for the fund.
Yes, sir. Okay, we will look into that.
This basically, I feel, will give you, apart from the drawdown and all the quality aspect, this should give you the buying criteria.
Yes.
Along with the TER.
Yes, sir. Understand.
Yeah, so you can create a separate column list where like just like he mentioned, the risk column, the basic column and all. So there, this also can be there.
Yes, fair enough. So we will definitely look into what other valuation data is available.
Please, sir, please.
Yes, thank you.
Please, thank you.
Yeah.
Thank you.
Okay. Any other questions? Please do let us know.
Yes, sir. Like I'm calling from TRA Consilium. I hope Pradeep sir has registered to this to your NGEN Market Premium.
Yes.
Yeah, like this is the first class I'm attending. Is this the first class like I need to attend, or any previous classes like?
Yeah, we have many sessions so far, and all of them have been pre-recorded and available on YouTube. So you can just you can either click on this link that Umair said inside the platform, or you can just go on Google and you can just search for NGEN Markets YouTube, and you will find this channel. And it has all of our sessions every Friday are recorded and put online. So they're just publicly available to watch. So you can have a look at them. And there are also other useful videos there, which are basically NGEN shorts. So you can look at the playlist. And if you don't have too much time available, you can also look at these small videos. They're about like 1 minute or something like that. And you can just quickly watch it, and it gives you small little functionalities and tools that are available.
Like if I get any doubt in between, like can I who is my point of contact? Like
sure. So if you could just ask, ask for whoever your coverage person is. They will definitely give you the details. But in any case, if you have any issue, the quickest way to get a response for any help is just to write an email at support@ngenresearch.com. And we usually reply very, very quickly.
NGEN?
Research.com. Support@ngenresearch.com. If you check the chat, it has been put there as well.
Okay, fine. Okay, fine.
No problem. Thank you. Any other questions? Please do let us know. Okay, there's nothing else. We can close for today.
Sure. Thank you so much, everyone, for attending this session. We will come up again next week, same time, 4 o'clock Friday. And you can also check out videos on YouTube as Arunab sir stated so. And you can also check out our updates on Twitter. So we are actively adding new updates on Twitter itself. So you can check those out accordingly into the system. And that's how it works out. Thank you so much, everyone. Have a nice weekend.